Hello, everyone. Welcome to today's edition of The Final Bar on Monday, November 18th. Nice continued upside for the market with consumer staples, real estate actually leading on the way up. Energy, healthcare, industrials dragging performance on the way down. Have a great show today. We have a new segment called ETFs Engage where we'll talk about some of the challenges and successes of investing in exchange-traded funds. Also, my guest Trevor Neil from the Beta Group in London joining us. Also a session on picking out stocks that are in the move. Ladies and gentlemen, this is The Final Bar. Hey everyone, welcome to today's edition of The Final Bar here on Monday, November 18th. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington, coming at you live from our new studio here in the home office in Redmond. Thanks so much for joining us today and every day. The goal with The Final Bar is to take a look at today's price action, to sort of unpack the themes, the movements, the patterns that we see on all the charts, reviewing all the charts using the power of StockCharts.com. But then most importantly, connecting it to the long-term trends. It's so easy to get caught up in a lot of the short-term movements, a lot of the short-term themes. And one of the great benefits, I would argue, of charts and technical analysis is it focuses you on the long-term trends, focuses you on how trends are evolving, on how momentum is shifting, how markets are inflecting. And hopefully in our 30 minutes together every day after the market close in the US, we can take a look at those charts together, make sure we're all oriented to the long-term trends and understand what are the charts we want to focus on. It's so funny, talking with a lot of individual investors, we spend so much time analyzing individual charts, trying to make a good analysis. We forget to ask the question whether or not we're looking at the right chart in the first place. So let's get to charts today. Let's talk about a market recap and start to understand some of the themes that we're seeing using StockCharts. So, starting with the members dashboard, pretty good day, although we ended up sort of flat to down, depending on where you're looking. But the S&P sort of chopped around, started a little low, kind of came around. So at the end, holding up okay, but not a directional, huge follow through. Right? Friday we had that big move to the upside, a big finish up to strengthen the close. Today, a little less of that. Today was sort of a visually, it looks like we're sort of digesting the gains from Friday. A lot of questions, a lot of uncertainty going into year end, thinking whether we will just continue on into new highs during the seasonally strongest part of the year, or whether we need to take a breather and start to correct a little bit, sort of digest those gains. So, so far this week is starting out in the middle, sort of saying it's more of a choppy processing type of pattern. Noteworthy that similar to what we saw on some of the days last week, mid caps lagged behind the S&P and then small caps at the bottom. So we have this same configuration with the largest companies at the top of the performance list, the small and mid caps at the bottom. We had a question recently in our mailbag about what that means, how much we can draw a conclusion from one day's activity. And my answer is one day is just one day. A series of one-day moves like this. If you see a pattern of large cap outperformance, small cap underperformance, we can start to question whether sort of the high beta speculative trade is really in place or not. But so far, again, for one data point, certainly small caps on the weaker side of it. Some really interesting themes looking at the sectors, and then I want to look at some of the charts here. At the top of the list, we have consumer staples, we have real estate. So this is certainly not the upside follow through, everyone in buying on strength type of pattern. It's a little more of a defensive trade with those at the top. At the bottom, we have energy. Energy has been a super challenging market to sort of think through, to sort of follow. While so much of the assets we look at, so many of the stock charts that I looked at yesterday in my weekly review of the S&P 500 charts, most of them are sort of up here somewhere. They're sort of up and to the right, testing resistance, having broken through resistance like financials, or very extended, something like Microsoft or Apple, something that's been in a really strong phase. Then you have energy, which is just kind of this sideways choppy move for the last 6 months, which on its own doesn't seem that bad, but the relative strength is where it's absolutely killing you. So being in markets that are stagnant when when the bulk of the trade is a lot higher is how you really start to underperform over a series of periods. So The XLE energy really continuing to show that it's failing at resistance, and the last couple weeks into today certainly seems to be the downside follow through that would support that as the overall environment. Let's look at today's chart, how it connects into the overall trend. And again, the focus here is on the long-term trend and how they're evolving. So the last 6 weeks have certainly been a period of strength. That sell-off the first week in October reversed. We then broke, tested, and then flew through the new highs. That was at the end of last month. November has certainly been a story of strength. There's only been a day or two of distribution of negativity before resumption of the uptrend. That is certainly a bull market looking chart. So today, closing above the open, this is on the S&P cash index, digesting what we saw on Friday, holding up very, very nicely. The key with the daily S&P chart that I would be paying attention to is the RSI. And again, the fact that the RSI is above 70 on its own in a vacuum is not necessarily bad. It's more descriptive. It's telling you stocks have been up a lot, which we know. What you want to start to look for is when there's a disagreement or a divergence between price and RSI. So at some point, potentially this week, maybe next week, we'll have to see in the holiday week in the US, we get some sort of pullback, some sort of digestion of all these gains and what the RSI does and whether it holds up okay, whether it comes back in the overbought region. Those are all the observations we're going to want to make. But for now, it's sort of long and strong, telling you that markets are holding up pretty well. Let's look at the Mindful Investor Live chart list. This is something we've reviewed many times, just to try to understand some of the key ratios, the key charts that will help inform us about the overall market strength or weakness. This is one we've reviewed into last week. And again, the question I would have with the breadth divergence now, you have the breadth on small caps. This is the cumulative advanced decline line going to new highs Friday again into this week, I would assume, certainly suggesting large mega caps are in a position of strength. Mid caps more sideways, small caps down. So again, it's just an early divergence here, a week or two old, but the beginning of that, if that continues to evolve, you start to see small caps really materially underperform. That would maybe cause you to question a little bit. I tell you what though, the new highs holding up just fine. So you continue to have a bunch of stocks in the S&P 500 going to new 52-week highs. That's been consistent over the last month. So really no weakness there that you might be worried about. This is the most interesting chart though I wanted to leave you with, talking about a market recap, is the percent of stocks above their 50-day. So the percent of stocks in the S&P above their 200-day, right above 75, that's where we've tended to top out in previous bull cycles. What's interesting though is if you look at the percent above the 50-day, it's actually gone lower and lower. So every time stocks have moved higher, less and less individual names within the S&P have confirmed that by going back above their own 50-day. This right now in the last week is the first time we've actually seen a rotation above there, a potential break of that pattern where you start to see some stocks kind of pile in and continue on, break back above their 50-day. So if that would continue higher, that's a really interesting chart to be paying attention to in the coming days, coming weeks for sure. So that's our market recap for the day. And again, the goal is to just touch on some of the key charts. Think about the long-term trends. And again, I would remind you, don't get too caught up in the day-to-day movements. Think about the long-term trends. Look at the charts over time and see how they've evolved. We want to stay in general on the right side of all those long-term trends. Our next segment is a new one. We're calling it ETFs Engage. I may have completely outed myself as a Star Trek fan, but so be it. The idea here, we've had it through the mailbag a number of times in recent weeks, questions about ETFs. So we've talked about China ETFs, we've talked about the XLF and financials, and again, looking at the surface level ETF, looking at a particular fund and how it's trading is sort of one thing. And the beauty about exchange traded funds is it gives you a very clear window into a lot of different asset classes. So 20, 30 years ago, it was actually pretty difficult to get a read on stocks versus commodities versus bonds because you didn't have as many tradable securities. You had to rely on different data sources, and institutions had a huge advantage over individuals because you had access to all that data. You had the ability to call brokers and see where bonds were trading and what happened with that. It has become much more commoditized now. So you as an individual investor actually have access to pretty decent price data, and you have a good way of accessing currencies and commodities and interest rates, and not just seeing where they're at, but trading them. And that's where ETFs are really, really positive, to say nothing of the fact that costs have come down so much when you're looking at ETFs. The downside, the ugly underside of ETFs that we don't like to think about are all the structural challenges that can come with it. So there are a lot of times there are random fees that might not be as obvious on the top, especially when you're able to trade them commission free. There are plenty of other ways that you can get bitten just a little bit with some sort of fee. So having an awareness of that is important. Also the liquidity. So a lot of ETFs are not super liquid, and that can create some problems. So what we want to do is actually, through this segment over time, touch on some of the themes, some of the challenges, and some of the benefits of looking at ETFs. And so in this one, I wanted to actually talk about commodity ETFs. You know, when I'm looking at the different asset classes, I usually use the lens of ETFs. So my market dashboard, my market summary page on StockCharts, I usually default to the ETF list. And I do that just out of habit, because usually if I'm looking at a commodity, I'm going to take one of the ETFs. That's how I'm going to chart it. So if you're not familiar with some of the tickers that I'm going to be talking about, this is a really good place to find the list of them. We're going to talk about a couple of them, in particular the crude oil ETF USO. We're also going to talk about the gold ETF GLD, but the things we're going to talk about are obviously very consistent with a number of these other ETFs as well. So again, this is on the market summary tab, and on the upper left, make sure you switch it to ETF, and you'll see the same page that I'm looking at. You can see all these different tickers. So I'm going to go to a chart that I created. I apologize, it's a little busy, but I'll walk you through what I'm doing here. At the top segment, this is the last 2 years, and this is the USO, the United States Oil Fund. Now, what you have to remember with ETFs is that ETFs actually have a lot of different structures, and when people talk about ETFs, that's sort of a catch-all for a lot of different types of products that include exchange-traded notes, ETNs, also unit trusts, which are a little different. Some of them have a K1 form that you will get if you invest in them. And again, if you're not familiar with anything I just said, please look into it further. It's not something we have time for, unfortunately. But the point is that ETFs have a lot of different structures. So number one, be very aware of what structure you're actually doing, what the tax implications are, and all of that. Also the expenses, and pay attention to what you're getting there. But what I'm doing here is I'm illustrating the USO. This is just the price of the ETF. Below there, I'm looking at the performance of the USO relative to the West Texas Intermediate Crude Oil Index. So this is essentially the price, the spot price, how much a barrel of oil costs. And so it's showing you the price of oil in the form of the actual rate that's out there. So now I'm looking at the performance of the ETF and the underlying, the thing that it's actually trying to track. Now, what's worth noting over the last 2 years is that these lines are not identical. If this was perfectly tracking oil, this should be pretty much flat, essentially telling you that the performance is the same, right? There's, when the U.S. oil ETF goes up $1, that's because WTI is going up, and it's really more percent. If they're going up the same percent, it would be the same. But what you can see is over the last 2 years, the USO, that ETF, has actually outperformed crude oil by about 4.6%. And a lot of that outperformance has come at particular times. There have been periods when they've moved in locksteps, but there have been other periods where you may have thought you were going to get a certain return profile looking at oil, and you actually got something different. Now, if you look at the correlation of the two, this is at the very bottom. This is the correlation, 20 days of USO and WTI crude oil, the index. You can see overall the correlation is very, very strong. And all that means is when one goes up, the other one tends to go up. That's makes sense. The problem is the percents, the actual relative movement. So there are days when the USO can appreciate or depreciate from a different value. Why does that happen? Long story, which we don't have time for, but the answer is something like the USO can't perfectly track crude oil because you're not actually buying crude oil. You're buying a product that provides exposure. So there's an extra layer in there, and sometimes it's not always balanced correctly or just based on the structure. When you have an ETF that goes into futures, a lot of times you will have a rollover and different issues because it has to roll over through different futures contracts. So there may be a period where you see actually a big spike in the price of one versus the other. It doesn't really line up. So the long story short is, what do you do about this? Well, number one, I would say it's just an expected part of investing in commodities through ETFs. You have to be aware that you're not going to get a perfect read on it. The reason why I just went through all that explanation, and thanks for sticking with me through all of that. The reason why I'm bringing that up to you is because if you look at my candle glance page, I actually look at WTIC, the crude oil price, and the USO right one next to another. I have GLD, the physical gold ETF, and I also have the gold index. So I can actually look at how they've moved relative to another. This has become very exaggerated over time with the dollar. So this is the UUP, which we often refer to as the dollar ETF. Look at that chart and then compare it to the US dollar here on the right. Directionally, they tend to agree, but over the longer period of time with any commodity versus a commodity ETF, they're going to become disconnected, and it's based on all those structural challenges that you have. So number one, if you can, make sure you look at both. Look at both the USO and the actual spot crude oil price to make sure that you're aware of the two. If you're going to look at one of them, I would always go with what you would actually execute. So if you're going to be trading the USO, I would be looking at that. If you're going to be trading UNG for natural gas or the GLD for gold, look at that. Make that the chart you analyze. Otherwise, you're going to have this disconnection between what you're analyzing and the trigger you're actually able to pull. So that was our first attempt at a segment called ETFs Engage. What we're hoping to do over the coming weeks and months are pick out some of these structural themes, answer some questions. So if you have any questions about particularly ETFs, shoot them to us via our email, which we'll share at the end of the show. We're going to take a quick commercial break. We'll be back with my guest, Trevor Neil from the Beta Group, joining us from London. See you in 1 minute.
The Chartwatchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chartwatchers newsletter.
Strategist here at StockCharts.com. Appreciate you joining us for the final bar. I want to bring on my guest, Trevor Neil from the Beta Group in London. Trevor, thanks so much for joining us.
It's a great pleasure, Dave. Good to talk to you again.
Trevor, known you for a number of years. Our former Bloomberg colleagues have always enjoyed following your work and having a good dialogue with you. Thank you for sending a couple charts ahead of time. The first one is a really timely topic, obviously, for investors in the U.S. It's looking at the relative performance of the U.S. versus the rest of the world. What are you seeing here?
Well, first of all, when you the information in this way, so this, you said the USA versus the S&P versus the rest of the world, the major market indices, the rest of the world, you can see this incredible outperformance that we've had in recent years. I mean, making these new highs. And I put in there, the blue line is above it is overperformance, below it is underperformance. And then I put two lines on which are one standard deviation, so that contains 68% of the data. So we're way ahead of that. This move is extreme, this overperformance move. And what I wanted to talk about is really what is likely to happen in this relationship. I think, and in my next chart, I think it will show that I continue to think that the stock markets will continue to boom, but I think there may be some rotation. There's a danger of some rotation out of the U.S. Stock market, so in favor of others. One of the things is that this is a relative thing. So we're looking at the performance of the U.S. stock market versus everything else. So everything else could start to outperform compared to the U.S. stock market by either the U.S. stock market going down and them going up, or them all going up, but the other ones going up more quickly. And that is actually what I think will happen. So this chart just shows the current position, this extraordinary position of complete dominance of the US stock market versus the rest of the world.
No, it's a fantastic chart. It shows you how extended that theme has played out. I mean, just much further than I think a lot of people expected here in the US. Your second chart was looking at more of a breadth take, looking at 52-week new highs. And this is on all country world. What does this tell you?
New 52-week highs. Yes, so this is, as you say, the whole world rather than just the USA. And what we're seeing is something very, very rare happening right now. And you see where you've highlighted, it's 15%, that line there. And so this is a percentage reading of stocks making new highs. And we've put a horizontal line at 15%. And then you can see there's highlighted one, two, three, four, 5 occasions there. We've come sharply up through 15%. And then look what happened next. So in the middle of 2003, we came up through 15%. Then we had that long bull market run going from 2003 up to 2007. Then the next occasion was in 2009, the end of 2009. Then we had a 2-year bull run following that. Then the next occasion was at the end of 2012. Then we had a long up run, a bull market then running through to 2015. And then we had the next one was at the end of 2016, circled there, the move to 50%. That gave us the big leg up through 2017, 2018. And then now, right now, we're having another one. And so when I'm talking about the previous chart and the outperformance of the United States, but here we're talking about 70 countries and the new highs, percentage of new highs, and the reading is indicating, and a very consistent indication, that this is another break and could be the beginning of another big leg like those other ones that I've just described there.
Wow, that's a fantastic chart. I love the history of it, and it's amazing how much this is actually lining up with some of these previous observations. I mean, so far, over the last 20 years, 100% of the time, that's actually followed through in a pretty big way. This is preceding each of the significant cyclical bull markets. Now, the last thing that you sent, which I really, really love, the RRG charts. We have Julius de Kempener has a show on StockCharts TV. I know a lot of people follow his work. Yes. What are you seeing now looking at the rotation of some of these global indexes? Yes, and just before
you mentioned about these charts. I've got to give a credit to a guy called Colin Thomas, credited him on the charts there, because 70 countries and the stock and index not including the United States. So that is his work, but these are graphs I want to share with you.
Very good.
Final point. So the first point is that we've got this outperformance of the United States. Second point is, I think that we're starting another significant bull market. And then now I think it might change in rotate in leadership of it. Now, I think many of your listeners will be familiar with this from Julius's work, but just for those that aren't familiar, what we've got here is a scattergram. In the middle of the scattergram is the MSCI World Index that we were looking at before. Then everything on the right of 100, the vertical 100, is outperforming the MSCI World. The furthest to the right is outperforming the most. Furthest to the left, the FTSE, is underperforming the most. Then we've got 100 across the screen, and we've got above 100 is with positive momentum. And so this is outperforming with positive momentum if it's in the top right-hand quadrant. If it's in the top left-hand quadrant, it's underperforming, but with positive momentum. That's things which are gaining relative performance. The worst place is bottom left, which is underperforming without a positive momentum. And then on bottom right, we have weakening. So these are outperforming things because they're on right of 100, but they are weakening in their momentum. So the most best looking things are moving into the top right in a northeasterly direction. That means they're increasing in positive momentum as well as relative performance. So what have we got? Looking at the S&P, you see the S&P is very close to the middle, the crosshair there. That means it's correlating and moving along with the MSCI World. Actually, it is the MSCI World. In fact, it's a large part of it. We've got the clear message of the underperformance of the FTSE, which in these little chevrons behind it are weekly samples. So behind it is last week, week before, and the week before. So we see it's heading westerly, which is the wrong direction. And this is largely actually to do with the strength of sterling recently, which is the FTSE is very vulnerable to that because it has many exporters in it. But we've got Japan up on the top right there, the top X there in Japan, which is in going the right way and in the right place. But then you see the rest of them there we've got the German DAX, we've got the Italian index, we've got the CAC index. So basically, we've got the rest of Europe, except for the UK, dominating that area. RTS is Russia, of course, but we've got the European stock indices dominating, outperforming currently the S&P. And I think there's going to be more growth of this in this scenario where we have overall strength and another leg up in world equities, but for a while, I don't know how long this will last, away from the S&P, where there seems to be some headwinds potentially for it, and allowing other ones, it made up, but actually better performance from other European shares, not yet the FTSE, but other European stock indices and markets are where you can get performance growth.
Trevor, those are three fantastic charts. I feel like with each one of these, we could spend an hour going through them. There's so many good data points. We'll just have to settle with having you back another time. Thank you so much for joining us. I know it's a late night for you. Really appreciate it, Trevor.
It's a
All right, everyone. That was Trevor Neil.
pleasure. Thank you very much, Dave. Good to talk to you again.
London.
Thank you, everybody, very much.
We're super appreciative that he's able to join us live via internet connection. So thanks so much, Trevor. Have a good night, my friend. So we're going to wrap up today's show with the a couple weeks. First is looking at consumer discretionary versus staples. This is a chart we've looked at regularly, the XLY versus XLP. At the bottom, it's two of the equal weighted ETFs, the RCD for consumer discretionary, RHS for consumer staples. Now, what's happened here, and as you can see, staples on a day that the market's holding up fine, staples actually led today, which means this ratio will continue to kind of slope down a little bit. So as the market is going to new highs, the charts that Trevor showed sort of confirm this beautiful bullish pattern that we've had. We're not getting that sort of confirmation from consumer. Now, again, this is one data point among many. I would love to see this ratio break out. What's interesting is the equal weighted ratio looks a lot better. It's already broken above trendline resistance, threatening to break to new swing highs. And if that would happen, I think that would sort of confirm, a little more leaning toward the offense. People taking, stepping on the gas just a little bit more with their positioning, especially institutions. Amazon's a big weight in consumer discretionary. That's what's certainly hurting that. Second chart we wanted to show you is the IWM, the Russell 2000 ETF, versus the spiders, the SPY. This is a ratio of small versus large. In general, small caps tend to do well in a bull market phase, and that is certainly not what we've seen. So we can see the ratios actually have been sloping downwards. We continue to see lower highs, and just recently we have taken another turn down. So every time this ratio just starts to turn up, I start to get a little bit excited, thinking this might be the inflection point. We might start to see an influx of buying into the small cap space. We sort of get disappointed it comes back down, and that's sort of what's happened in the last couple weeks. The ratio's turned back down. It's now threatening to get back to all-time lows here for the last year. And again, the market can go higher without small caps being the driver, but it's unusual, right? You kind of want to see, all else being equal, you probably want to see small caps start to rally. Finally, and it plays a little bit on some of the charts that Trevor showed. I love his chart looking at breadth globally, and also the one showing you how the U.S. dominance to the rest of the world is super overextended. That was that first chart he showed you. And this is the way that I tend to look at that theme. This is the ratio of the spiders, the SPY or the U.S. versus ACWI, which is All Country World Index, which is everything, 50% U.S., 50% non-U.S. This ratio has certainly turned higher, showing this follow through to the upside, showing you an influx of buying. Again, that theme of U.S. over the world has not stopped yet, continues to go higher. At some point, it will be over. And again, my concern, the reason why you want to watch this chart is to make sure you're on the right side of it. If and when it does turn materially lower, make sure you have a good sense of where international fits into your allocation. Folks, that is our show for today for a Monday afternoon. Thank you so much for joining us. You can get questions to us anytime via email, thefinalbar@stockcharts.com. You can also look us up on Twitter @finalbarsctv. Look at our YouTube channel for Stock Charts. You'll see all of our old interviews, all of our old videos. We've got a lot of great stories, a lot of great themes over recent weeks to share with you. You can find them all there. From StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.